rising populism in many countries, and that is a direct result of globalization worked for the entire world, but did not work for many segments. And I think those segments were left behind, and globalization 2.2, and I think this is a fair assessment, we need to broaden the economies to make it work.
$68 trillion. That's the amount of money that will be invested over the next 15 years in a single asset category. To put that in perspective, it's like building the entire U.S. interstate highway system and the transcontinental railroad every 6 weeks for the next 15 years. And guess what? 99% of everyday investors won't be able to access these returns unless they know what I'm about to reveal today. Larry Fink, CEO of BlackRock, the world's largest asset manager with over $10 trillion under management, just published his annual letter to investors. And what he wrote should set off alarm bells in every portfolio. Stay with me, because in the next 10 minutes, you'll discover how the 60/40 model you've been using for years is about to become obsolete. Welcome to Asset Archive. I'm David, and today we're analyzing one of the most important financial documents of the year. Larry Fink isn't just any investor. When he speaks, markets listen. And in his 2025 letter, he delivered a clear message. The way we invest is about to change radically. In this video, you'll discover why the classic 60/40 portfolio isn't enough anymore, what private markets are, and why they've been off limits to you until now, how the 50-30-20 model could be the future of investing, and most importantly, how tokenization could democratize access to billion-dollar opportunities. But first, we need to understand the problem we're facing. And it all starts with a question. We're living through the greatest period of wealth creation in human history. Over the past 40 years, global GDP has grown more than in the previous 2,000 years combined. Yet, you hear anxiety everywhere. People are more worried about the economy than ever. And the reason is simple. Not everyone has participated in this wealth. Fink says it clearly. Capitalism did work just for too few people. Today we have twin inverted economies, one where wealth builds on wealth, another where hardship builds on hardship. And this has reshaped global politics. But here's the interesting part. Fink doesn't say we should abandon capitalism. He says we need to expand it. We need to finish the democratization of markets that began 400 years ago in Amsterdam. Wait, Amsterdam? That's right. In 1602, the world's first stock exchange opened there. And among the 1,143 initial investors, there weren't just wealthy merchants. There were artisans, shopkeepers, silk weavers, and at least 2 maids who each invested 50 guilders, enough to rent a modest cottage for a year. The point? Markets were always designed to democratize investing, but somewhere along the way, we got lost. So, where did all this capital end up? It's locked away. In the United States alone, roughly $25 trillion sits idle in bank accounts and money market funds. It's abundant capital, but deployed too narrowly. Meanwhile, the assets that will define the future, data centers, ports, power grids, the world's fastest-growing private companies, are not available to most investors. They're in private markets, locked behind high walls, with gates that open only for the wealthiest. Why this exclusivity? 3 reasons: risk, illiquidity, and complexity. But Fink says nothing in finance is immutable. Private markets don't have to be so risky, opaque, or out of reach. Not if the industry is willing to innovate. And that's exactly what BlackRock has done over the past 14 months. They've acquired 2 of the top firms in the fastest-growing areas of private markets, infrastructure, and private credit. Now, let's talk real numbers. BlackRock proposes a new portfolio model, 50-30-20, 50% in stocks, 30% in bonds, 20% in private assets like real estate, infrastructure, and private credit. Why this shift? three key advantages of private assets. First, inflation protection. The revenue infrastructure generates, tolls, utilities, typically rises along with inflation. Second, stability. Unlike public markets, infrastructure returns tend to be far less volatile. Third, superior returns. Historically, allocating just 10% of a portfolio to infrastructure boosts overall returns. And here we arrive at the shocking number from the beginning, $68 trillion. This is the estimated global demand for new infrastructure investment by 2040. Governments can't fund it. Deficits are already too high. Big tech companies, despite billions in cash flow, aren't equipped for this scale. A single AI data center can cost between $40 and $50 billion. Who's left? Investors, but only if they can access it. Now let's talk about the real game changer, tokenization. The global financial system moves money through infrastructure built when trading floors shouted orders and fax machines felt revolutionary. Take SWIFT, the system that handles trillions of dollars in global transactions every day. It works like a relay race. Banks hand off instructions one by one, checking details at each step. Made sense in the 1970s. Today, it's like routing emails through the postal office. Tokenization changes everything. If SWIFT is the postal service, tokenization is email itself. Assets move directly and instantly. What does tokenization mean? Turning real-world assets, stocks, bonds, real estate, into digital tokens tradable online. Each token certifies your ownership, like a digital deed. But here's where it gets really interesting for the average investor. Democratization of access. Tokenization allows fractional ownership. Assets can be sliced into infinitely small pieces. This lowers barriers to investing in valuable assets like private real estate and private equity that previously required hundreds of thousands of dollars. Democratization of voting. When you own a stock, you have voting rights. Tokenization makes this easier because ownership and voting rights are digitally tracked. Democratization of yield. Some investments produce much higher returns, but only big investors can access them. Why? Friction. Legal, operational, bureaucratic. Tokenization strips that away. Fink predicts that one day, tokenized funds will become as familiar to investors as ETFs. There's one problem to solve: digital identity verification. But India, the world's most populous country, has already done it. Today, over 90% of Indians can securely verify transactions directly from their smartphones. Okay, this all sounds fantastic, but let's be real. What are the risks? First, illiquidity. Private markets aren't liquid like stocks. You can't sell in 2 seconds. You must be prepared to lock up capital for years. Second, complexity. These investments are more complex. They require greater due diligence and understanding of specific risks. Third, still limited access. Despite progress, many private funds still have minimum thresholds of $100,000 or more. Fourth, regulation. Tokenization is still in its early stages. Rules could change. But, and this is a big but, the opportunities are enormous. We're witnessing a paradigm shift. 81% of U.S. companies with over $100 million in revenue are privately held. That percentage is even higher in Europe. IPOs are becoming rarer. Companies are staying private longer, which means if you want access to real growth, you need to be in private markets. Private credit, loans made by investors instead of banks, is projected to more than double by the end of this decade. And remember, historically, even just 10% allocation to infrastructure increases total portfolio returns. The question isn't if this will change the investment landscape. The question is, will you be ready when it happens? So, what can you do today? First, educate yourself. Private markets aren't just for the ultra-wealthy anymore, but you need to understand how they work. Second, Talk to your financial advisor. Ask about accessible private market options, evergreen funds, ELTIFs in Europe, or new structures that are emerging. Third, reevaluate your portfolio. 60-40 worked for decades, but the world is changing. 50-30-20 could be the future. Fourth, keep an eye on tokenization. When it takes off, and it will, it'll change everything. Now, I want to hear from you. Write in the comments. Do you already have access to private markets? Are you interested in tokenization? Do you think the 50-30-20 model makes sense? And if you enjoyed this video, leave a like and subscribe to Asset Archive. We publish in-depth analysis like this every week. There's also a bonus. I've created a free PDF guide that summarizes the key points from this analysis and includes additional resources to get started. Link in the description. In 1602, two Dutch maids invested the equivalent of a year's rent in the world's first stock exchange. That bet probably changed their lives. Today, we're facing a similar moment. The democratization of markets is unfinished. But with private markets opening up and tokenization on the horizon, we could be just a few years away from a financial revolution. The question is, will you be part of this revolution, or will you stay on the sidelines while others build wealth? Larry Fink has thrown down the gauntlet. $68 trillion are at stake. I'm David, and I'll see you in the next video where we'll analyze exactly which platforms are already offering private market access for retail investors. See you soon.